Hi, in this video I'm going to cover the journal entries for issuing bonds. Now corporations record bond transactions when they issue bonds, which is also known as selling them, redeem bonds, which is buying them back, and also when bondholders convert their bonds into common stock. Now if a bondholder sells their bond to another investor, that is completely separate from the company. It does not get recorded to the company. Any wealth that's made between those transactions is between the holder of the bond and the person they sell it to. And so in this video, I'm just going to cover the journal entries for the issuance of the bonds. Now when a bond is issued, investors compare the contractual rate of the bond, which is the rate that will be paid on that bond, versus what is the market rate? What is the rate that investors are looking for? And so if the contractual rate of 10% is same as what the market is looking for, the bond is issued at face value. And if the contractual rate is higher than what the market has, then the bond will be issued at a premium. And if the contractual rate is lower, then it will be issued at a discount. So what does this mean? When a bond is issued at face value, that means the bond price is sold at 100, they call it, which means 100% of face value, which means that the cash that the corporation will receive is equal to the bond principal amount. If a bond is sold at a discount, then the bond is sold for an amount less than 100, such as saying the bond sold at 98. In that case, the cash the corporation receives is actually less than the principal that they will have to pay back to the investors. If a bond is sold at a premium, then it is said to have sold above 100, so maybe at 101, which would be 101% of face value, which means that in fact the corporation actually receives more cash than the principal amount of the bond they're going to have to repay. And the reason investors are willing to pay more is because the interest rate that is being paid on the bond is higher than other interest rates that are out there and available to investors. So now let's look at example journal entries. On January 1, Grandview issues 100,000 5-year 10% bonds at 100, which tells us it was issued at face value. So our entry to record the sale is a debit to cash and a credit to bonds payable. And our bonds payable account is a long-term liability account because it's a 5-year bond. And the bonds payable account always represents the principal amount that is owed on the bonds. And since it's just now been issued, the whole $100,000 is owed on that bond. And that bonds payable account stays true no matter if the bond is issued at face value, a premium, or a discount. Now let's look at this example. Grandview is going to issue the same bond, but this time it's sold at 98, which means it's sold for less than face value, so it's sold at a discount. So again, we're going to credit bonds payable for the $100,000 because our bonds payable account always represents the principal of the bond. Then we have to calculate our cash. So if our principal was $100,000 and it sold for 98% of that face value, then the actual cash that Grandview is going to receive is only going to be $98,000. And so that $2,000 difference then is recorded as a debit to an account called discount on bonds payable. And that discount on bonds payable is a debit normal balance because it offsets our bond payable. It increases with a debit. And so on our balance sheet, after they issue this bond, you would see the bond payable amount for the principal, and then this discount actually decreases what we call the carrying value of the bond. Because this discount actually results in less cash that was received, so it actually increases the cost of borrowing to the company because they received $2,000 less up front. Now let's look at the same bond, but this time being issued at a premium. So the bond is issued at 102. So again, we're going to credit bonds payable for the principal amount of that bond. Then we're going to calculate the cash received, which this time is 100,000 times 1.02. And so the company received $102,000 in cash, and because they received more cash than the principal of that bond, we get to record a premium on bonds payable. And that premium then is a credit normal balance. We're increasing it here with a credit. And so if the bond is issued at a premium, when we look at it on the balance sheet, that actually increases the carrying value of the bond. And so now they have an extra $2,000 basically that is going to decrease their overall cost of borrowing. Right? Our cost of borrowing is the interest that we pay on the bonds. And so we have a $2,000 kind of extra to offset the interest that they will have to pay over the 5 years on this bond. So let's look at paying the interest. Okay, we're back to our same bond, and just to make it easy, we issued at 100. Okay, but it doesn't really matter what you issue it at. Your interest payments are always based on the contractual rate. And so to record our interest here, we can see that it's paid annually, which means just once a year. And so we're going to take our principal times our contractual rate of 10%, and the $10,000 is our interest to be paid. Again, it doesn't matter if the bond was issued at a premium or a discount or at face value. The interest is always based off of the principal times the contractual rate. Okay, and so now it's December 31, so we're accruing the interest here at the end of the year. So we're going to debit interest expense and credit interest payable. And now on January 1, they're actually going to make that payment. They're going to pay the interest to the bondholders. So we're going to debit interest payable and credit cash for that payment. And so now we've gone through the basic entries for issuing bonds.